Gold is hot right now with the market collapse, and this could be the asset that saves your portfolio. But investing in gold is more than just calling into that 3 a.m. infomercial. What are the best ways to invest in gold and the pros and cons of each? In this video, I'll reveal 5 ways to buy gold, including 4 that I've used myself, and how to get started right now. We're talking buying gold as an investment today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. I want to send a special shout out to all you in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, last week I showed you how to analyze gold as an investment and when to buy, and it was one of the most popular videos in a long time. There's just something about holding gold as an investment, that gold fever that we all get, and the stock market's recent crash has sent the market into full-blown gold rush. We talked about 3 ways to invest in gold in that prior video, but I wanted to go into more detail in this one and show you all the ways that I've used to invest. In 5 methods from futures to stocks, buying physical gold, I'll show you how to get started and the pros and cons of each. Again, I want to thank Vaulted for sponsoring this video. The platform lets you invest directly in gold bars with insured storage in the Royal Canadian Mint or physical delivery right to your home. The gold is certified 99.99% pure, and it took me less than a minute to set up an account and buy my first gold bar. So our first way to invest in gold is by buying that physical bullion, gold bars. I'm planning on doing a step-by-step on buying that physical gold next week, but this is really the ultimate in safety. I've used futures to buy gold and invested in stocks, but all these carry that hacking risk or the institutional failure. And when all your gold is in just bits and bytes on a computer screen, it doesn't take much to destroy those records and your investment. So buying physical gold is done through a broker, and most investors take physical delivery or they store it in a depository. And for example, the Vaulted app is built by McAlvany Financial Group, a broker with 48 years advising clients, and all the gold is stored in the Royal Canadian Mint. This is the official government vault, audited each year by the Auditor General and insured by Lloyd's of London. It took me less than a minute to set up my account on Vaulted, and the app makes it extremely easy to buy gold. You just link up your bank account, make a deposit, and then buy however much you want. The gold is stored in the mint and verified monthly. Now you can gift gold to a friend with just their email address and even get your gold delivered to you by FedEx. The pros of buying physical gold include the ultimate in safety, owning that physical asset instead of just a financial record. You get all the upside benefits of the investment, including an inflation hedge and that return potential. The biggest con of buying physical gold is the premium that you're going to have to pay to buy and sell. On average, brokers charge a 4% fee for each transaction, plus an annual expense to store and insure the gold. Now, Vaulted's fee is about half that at 1.8% for each transaction, but that's still higher than we'll see with those stocks and futures. Now, if you're holding the gold yourself, you've also got that added risk of theft or loss. Physical gold also doesn't pay a dividend, so your sole return is going to be selling at a higher price. I'll leave a link to Vaulted in the description below for more information. I like the platform for that storage security and the company's long history. Another way I've invested in gold before is through futures contracts. Now, one thing you got to understand about futures is they can be more speculative investment than that longer term investment that we usually talk about on the channel. What I mean by that is futures are contracts to buy or sell a commodity at some point in the future for a certain price. These are mostly used for risk management. For example, a wheat farmer can sell futures contracts for September delivery. Now, he locks in the price that he's going to get for that crop and doesn't have to worry about the price swings. Conversely, a wheat user like maybe General Mills making your breakfast of champions, they can buy those contracts and lock in the price it's going to pay for supply. Now, futures contracts. So each contract for gold is for 100 troy ounces of 99.5% purity. But what makes futures so interesting is you can buy these contracts for a fraction of the actual cost. So 100 troy ounces at a price of about $1,600 per ounce, each contract is actually worth $160,000 in gold. But you only need to put up about 5% of that price to buy the contract. You only need $8,000 in your futures account to start that position. That's a 20-to-1 leverage, and it means a simple 5% increase in the price of gold is going to double your money. Of course, that leverage works the other way too. Okay, the value of each contract in your account is going to be marked to market each day. That means the value is adjusted according to the actual contract's change. So if your account balance falls below a certain level, then you have to add funds or your contract is going to be sold. It's going to be liquidated. This is why I generally recommend not using full leverage on a contract. For example, here you might be able to use 15-to-1 leverage, which is still a lot of leverage. Now, the biggest pro of trading futures is just that leverage available. I made over $20,000 in 2 months in 2016 on oil futures. I bought 3 contracts worth $114,000 in West Texas crude, that's WTI, but only had to put $7,000 in the account. The contracts were for May delivery at $38 a barrel. I was able to sell them for $45 a barrel before that expiration in May for a gain of $21,000. Other advantages of futures are that they're highly liquid, meaning you can buy and sell these things in less than a second, basically just like stocks. Now, unfortunately for a lot of people, that leverage can be a disadvantage as well. It takes very little to wipe you out completely here. Even on a 10-to-1 leverage, a 10% move in the price is going to mean a total loss in your account. Now, contracts are also time limited, so you're going to buy a contract that expires in a month or two, then you have to roll that over into another month contract if you want to keep that investment. Finally, this isn't really a direct investment in gold either, but a contract on the price, so it's really not quite the same as these other methods. Most brokerage and investing sites are going to have a futures platform, usually with around a $10,000 minimum to start trading. Because of that leverage though, this is definitely one where you want to do your homework and you want to understand what goes into these prices on a day-to-day basis. Our third method of buying gold is to buy those mining company stocks. Now this is where most investors start, but it's not necessarily the best way to invest in gold. I like the liquidity in stocks, so meaning you can buy and sell your gold miners fast, but I think most investors underestimate the amount of analysis that goes on into this. You really do need to go into the financials in your mining stocks, see which companies have the best reserves, the lowest cost mines, and which might offer the best returns. Gold miners were absolutely destroyed when the price of bullion dropped in 2011. Like most commodity markets, miners ramped up that supply as fast as possible as the prices rose, got caught when prices came down, and then had to cut everywhere possible. Now the miners that have survived, it's because they've become super efficient, focusing on those lower cost assets. With the backup in prices over the last couple of years, we've seen a jump in the mergers and acquisitions in these big players trying to buy those assets fast without development. We saw Barrick Gold merged with Randgold in September of 2018 to briefly create the largest miner before Newmont acquired Goldcorp in January 2019. And with the recent jump in price, I think there is still an opportunity, especially in some of those junior miners, the smaller miners, as those acquisition targets. But you need to be analyzing these. You can't just pick a name or something you've heard on CNBC. So with the miners, there are really 2 measures that you want to watch out for. These are the cash costs per ounce and then the all-in sustaining costs. Now, cash costs include production costs, mine level administration, and the processing to produce each ounce. For the largest miners in that GDX index, that was about $616 an ounce as of last year. Now, probably more important as a measure though is this all-in sustaining cost per ounce, or the AISC. Now this is also going to include the cost of maintenance expenses to keep those mines running. So the average here ran $893 an ounce for miners last year. So what you want to be doing is looking for companies that can produce under that amount, lower than the cost of the industry. Besides cost, pay attention to reserve estimates and the miners' production schedule for bringing those assets online to production. This is going to be really important because if you can find a junior miner, so smaller miners with a big field coming into production soon, even if it has just a little bit higher cash costs, it might make for a good takeover target from a larger player that thinks it can lower those costs. Pros of buying shares in gold miners is just this ease and liquidity. Just like with those futures, you can be in and out of these stocks in seconds if you like, and the price spread on stocks is less than a couple of pennies. Unlike futures though, you don't need a few grand to get started. In fact, some of these junior miners trade for less than $5 a share. The big downside to gold mining stocks, though, is they don't necessarily track that price of gold very well. So here's a 5-year chart of that GDX Gold Miners Fund in blue against the Spider Gold shares, which tracks the gold price here in red. You can see how volatile the miners have been even as the price of gold has stayed relatively flat. So with gold miners, you get a lot of that company-specific risk and the volatility. Most of these miners also produce other metals like copper and silver, so it's not a pure play on gold. Getting started in these is almost too easy. You can open an account on any investing platform, but you really do need to be doing the analysis before jumping in on a stock. So similar to buying gold miners, you can buy the ETF or a fund tracking the price of gold. Now there are other gold funds, but by far the most popular is the Spider Gold shares, ticker GLD. The shares are backed by physical gold held in trust and stored in vaults primarily in London. Now, each share is a fractional amount of gold, so the trust actually buys and sells physical gold according to how many shares are bought by investors. Pros of the fund are that the investment tracks the price of gold directly, and you get that ease and liquidity of stocks. Now, I'm not quite sure if this expense ratio is a pro or a con though. The fund charges a 0.4% annual expense on assets for management, which is more than those miner stocks or some of the other methods we'll talk about, but you won't be paying the fees like with physical gold. The downside to the ETF is just like physical gold, there's no cash flow with dividends. Your only return here is going to be buying low and selling high. And like we talked about before, this is also a financial asset, so a record with that gold trust. So there's also going to be that electronic risk as well. Now with the gold fund, you can buy it and sell it just like stocks. So getting started is going to be pretty much the same with the miners, except instead of doing that company and level analysis, you're going to be analyzing the price of gold. Now our fifth way to buy gold, and this is the only one I haven't tried yet, is buying gold certificates. Now these aren't used nearly as much as in the past, but these were basically the world's first banknotes. So as early as the 17th century, goldsmiths in London and Amsterdam were issuing these certificates on physical gold holdings. Pretty soon they were being used by banks as an exchange for goods. Today there are still some Swiss and Australian banks that issue certificates and a few investment sites, but it's really limited. The Perth Mint program is probably the most widely used, and I definitely caution about using just any website. The pros here are similar to that Gold ETF, where you get direct exposure to the price of gold, though this one doesn't benefit from that ease or liquidity. The drawbacks to gold certificates are so many that I'd really hesitate to recommend them. The certificates are only as good as the company backing them, and there are plenty of outright scams on the net. They're illiquid, meaning it might take a while to sell or get a redemption of your gold, and the fees are higher than the other methods we talked about. Click on the video to the right to see if gold is a good investment right now. I'll show you exactly how the price of gold is determined, the factors to watch, and how to know if you should invest in gold. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.